Hello everyone, welcome again to this hybrid accounts accounting channel. Today we are just going to look at how we measure the value of the PPE subsequently. We said that initially, for the previous lecture, we said for the previous lectures, we said that initially they are measured at cost, but subsequently we use cost model that we also described with a detailed example in the previous video. But today we are just going to take a look at revaluation model. Now, subsequent measurement of property, plant, and equipment actually involves either cost model or revaluation model. Because initially the asset is measured at cost using cost model, so we presume to proceed with the cost model until when the revaluation model can be used. By using the revaluation model, you'll need to know the fair value of the asset. So revaluation model has got its own principles. So when we reach it, be very careful. So how do we deal with the revaluation model on PPE? We carry the asset at the revalued amount. Instead, look at the cost model, we used cost, then less depreciation and accumulated impairment loss. But as for the revaluation model, we measure the asset at the revalued amount. After revaluing the amount, you do the same. You less depreciation and impairment loss, but from the revaluation date. That means if you had an asset for 8 years ago, you have depreciated it for 8 years, but now actually you have revalued it. After revaluing it, its new cost, its new carrying amount would be the revalued amount minus depreciation that will come from the date of revaluation. So you ignore the previous depreciation, because that will be included actually in the computation of gain, or in the computation of actual revaluation gain or revaluation loss. Because not valuation gain or loss, we compare the carrying amount and the revalued amount. So that's why we say carry the asset at the revalued amount, being its fair value at the date of revaluation, less any subsequent, not this word subsequent here. And the cost model, we didn't say subsequent, but here we say subsequent. That means depreciations and impairment losses, they are on from the date of revaluing the asset. So any subsequent accumulated depreciation and subsequent accumulated impairment losses. So we do something like this. So we say the revaluation model is available only if fair value of the asset can be measured reliably. This is very much obvious. If you cannot determine the fair value, how could you know how could you use the revaluation model? Because the revaluation model requires fair value. So this is just an example that we usually determine fair value based on the market. That this is actually the most reasonable way of computing fair values. Although if nothing is available, we could also try to estimate it maybe using present values of future cash flows. But actually, as it is, fair value is obtained from the market. So we say, for example, the market value of land and building. You know, land and buildings is this represent a property, and this is I-16 property, plant, and equipment. So we can also consider them. So the market value of land and buildings usually represent fair value, assuming existing use and line of business. And such valuations are usually carried out by professionally qualified valuers. In order to know the fair value of the land or the building, a professionally qualified valuer comes and then evaluates and comes up with the value of such property. So this is just actually maybe when in the job actually, because in an exam it's not like it could be asked something like this. And then we are told here, in the case of plant and equipment, fair value can also be taken as market value. Of course, we never have market value use it, but not all assets would have the market value. So that's why we say, where a market value is not available, however, depreciated replacement cost should be used. Do you know the meaning of depreciated historic replacement cost? Depreciated replacement cost just means this one. Let's say you have an asset today. I'm repeating again. Let's say you have an asset today, and that asset maybe okay, let's say you bought an asset for 100 million 4 years ago. Then you have depreciated it. Actually, right now in the books, that asset maybe let's say that asset is carried at 40 million. The asset is carried at 40 million, but 3 years have passed. Maybe the asset is carried at 40 million, but 3 years have passed. If you cannot obtain the fair value, what do? You just go back, you presume, we take the depreciated replacement cost. You ask yourself, oh, this car, let's say, is 6 years old. This car is 6 years old. All right, the car is 6 years old. Then what do I do? If I want to buy it now, if I want to buy the new one, if I want to replace, what is the cost of replacing this car? Maybe this car cannot be replaced for 150 million, the new one. You know that your car right now, actually 6 years have been spent already, but you need to replace it with a new one. So if you replace it with a new one, you determine the replacement cost currently of the new one. Let's say it's 150 million. After getting that 150 million, you depreciate it by the years that this asset has already stayed. So if this asset has already stayed for 6 years, then you depreciate it by 6 years. That's why you say depreciated replacement cost. So first identify the replacement cost of the new asset and then depreciate it by for the years that have already passed on the original asset. That's what we call depreciated historical cost. I think I can illustrate it a bit here. Depreciated historical costs. Let's say you have an asset with a carrying amount now of 35 million. Let's just presume this one, and then actually we say that 5 years have passed. 5 years have passed since it was purchased. And let's say maybe it had a useful life original. It has an original. It had an original useful life of let's say it had an original useful life of let's say that if, let's say 10 years, let's say 15 years. It had a useful life of 15 years. But we know that 5 years have passed. So if 5 years have passed, then what? You could need to know. Anyway, we have already been given the carrying amount here. 15 years have passed. Then you want to say, oh, what would the fair value of this asset be? Going to the market, there is no fair value. What would you do then? This is what would have followed. First of all, you would have asked yourself, what amount of money could I use to replace the asset? So I would find the replacement cost now. Let's say this asset can now be purchased at, let's say 60 million. 60 million. Then you ask yourself, this 60 million, but you cannot compare this asset and this one because this is the new one. Let's say it still has a useful life for 15 years, while this one actually 5 years have already passed. So what you do, you have to eliminate the depreciation for 5 years. So compute the accumulated depreciation for 5 years, which would be how much? First of all, depreciation for 1 year. Depreciation actually, if not told, we use the straight line depreciation. So 60 million minus the residual value, which is 0, let's say, because it's not given, over the number of years, that is 15. Now, after obtaining this figure, you multiply it by the number of years that have passed already, which is 5 years. And if you do this, actually, you'll end up with the accumulated depreciation of how much? Of 20 million. This will be the accumulated depreciation. So, to obtain the depreciated replacement cost, how would you obtain this now? We say that we take the original cost, that is 60 million, and then we minus the accumulated depreciation, 20 million, ending up with 40 million. So this is a depreciated historical cost, depreciated replacement cost, and we can presume this to be the fair value. So that's what we do. I hope you got me well. So we can proceed now. That's what you're told. There may be no market value where types of plant and equipment are sold only rarely or because of their specialized nature. Something may not have actually a market value. So if something like that, actually you can use the method that I have just specified. So now we're just going further into more details and more points. These are the principal requirements under the revaluation model. Let's just go here and we'll take a look at just a single example, and then I will proceed at the next time. Now let's take a look at the principal requirements under the revaluation model. What does the revaluation model require us to do? This one is very, very, very important. First of all, the frequency of valuation, fair value changes. So how often should I check the fair value? Actually, the number of times to check the valuation depends on the volatility of fair values of individual items or property, plant, and equipment. If fair value changes so regularly, actually, I would also have to increase the frequency of valuation. But so that's just what you do. But also you have to be careful. Something may be changing frequently, but by a very small margin. So if it's changing by a very small margin, you can just neglect it. That's why we say here, the more volatile the fair value, the more frequently the valuation should be carried out. But I'm repeating again, but where the current fair value is very different from the carrying value, then a revaluation should be carried out. So you can just increase the frequency of valuation, but actually make a revaluation, there is, there is making frequency, there is an making revaluation, frequency of revaluation, there is making frequency of valuations, but to actually revalue the asset is a different thing. I may be saying maybe in a month, see, this asset actually its fair value changes very frequently. So maybe I check it every 2 weeks. But it's not like whenever you check and you find a small difference, you have to make a revaluation. No, you could just leave it as it is. In case it becomes significant, it becomes very different from the carrying value, then I can revalue the asset. So that's what we do. And then we have number 2 here. This is a very common question and example explaining principal requirements of revaluation model. Number 2, when an item of property, plant, and equipment is revalued, when you revalue an asset, the whole class, now understand this one. You have your PPE. When a single item of property, plant, and equipment is revalued, the whole class of assets to which it belongs should be revalued at the same time. The whole class should be revalued and at the same time, to prevent selective revaluation. You cannot say maybe I have a plant, I'm revaluing one plant and I'm leaving another. Or I'm saying, oh, this one I'll revalue 2 months, 2 months forward, or one year in time. That one is not allowed to avoid selective revaluation. Now let's just go. So simply speaking, if one item of a class of PPE is revalued, you have to revalue them all. What do I mean by this one? First of all, what I mean is, we've spoken of property, plant, and equipment. Property can be considered to be in its own class, and property means what? Property is always land and the building. So basically, you cannot revalue one building and leave the others, or you revalue the building and you leave the land. So that's not allowed. So we have property, but you could also say maybe plant and equipment, something like this. These could be examples of classes. You could say that those are examples of what? Of classes. So that's what we do. So just be careful on this. Another thing here, we say that an increase in value of an asset. Now, this one is also a very, very important point. An increase in value of an asset from revaluation shall be transferred to revaluation surplus and equity through other comprehensive income, unless such increase is reversing a previous decrease. Unless it is reversing the previous decrease, which was recognized as an expense. To the extent that this offset is made, the increase is recognized as income, and any excess is taken to revaluation surplus. Let me explain this. This is a very, very important point. Let me go practically more. Let me be more practical. This is what I'm speaking about. Before even going to actually the other point, point number 4, I'll actually explain it before even reading that point number 4. So let us start with this point number 3. This is what I'm saying. Let's say you had your asset at 40 million, and now you have revalued it. It has gone to 50 million. Ignore this. From 40 million to 50 million, what do? My asset has gone up by 10 million. So I have to increase my asset. Asset has a debit nature, so I'll debit my PPE by how much? By 10 million. I think this is clear. 10 million, very clear. And then, since it is a revaluation gain, I would have to credit the gain. That gain actually is taken to actually, if you speak of the statement of financial position, you could say that it is taken to revaluation surplus. This revaluation surplus actually states in the statement of financial position. But revaluation surplus represents equity, and equity actually always comes from what? When speaking of equity actually is just a combination of a lot of items from the income statement. Of course, not all components of equity. Things like revaluation surplus, maybe translation gain, maybe retained earnings, they all come from the income statement, except things like share capital, share premium. So you credit the revaluation surplus, but why revaluation surplus? There is a difference between revaluation surplus and the retained earnings. If there is a revaluation gain, an item actually passes through other comprehensive income as a revaluation gain. We call it a revaluation gain, and this revaluation gain passed through other comprehensive income, something like this. And here you will have your 10 million. Now you have to be very careful, very careful on this. So if there is a revaluation gain, you do not, distinguish between two items. There is something called profit or loss, and there is something called other comprehensive income. They are two very different things. Statement of profit or loss and the statement of other comprehensive income are two different things, although they are usually incorporated into a single statement called statement of profit or loss and other comprehensive income, or simply statement of comprehensive income. So revaluation surplus does not go to profit or loss, but it goes to other comprehensive income, and that's why it goes to revaluation surplus. Anything that goes through profit or loss will ultimately go to retained earnings because it is realized. So this is what we do. Now, what point number 3 is trying to explain is, listen, the asset has moved from 40 million to 50 million, but let's presume that suppose there was a previous revaluation loss. This is a gain. There is a gain by 10. What there was if there was a previous revaluation loss, we'll say what? Let's say there was a previous revaluation loss of say 6 million. There was a previous revaluation 6 million. Revaluation loss, there's a difference between revaluation gain and revaluation loss. Revaluation gain goes through other comprehensive income, but the revaluation loss goes through profit or loss. Revaluation loss goes through statement of profit or loss. If it is like this now, and we are just reversing, what should we have done here? We would have changed something here. It wouldn't have been the same. We would have done it like this. First of all, you would say the asset increased by 10 million, so no problem. I would have debited PPE by how much? I would have debited my PPE by 10 million. Very fine, no problem at all. After doing this, I would have to credit now. This credit, I should have a total credit of 10 million. But our point here now is, do we take it to other comprehensive income with above, or do we take it to profit or loss, or do we apportion it? What do we do? Generally, when there is a revaluation gain, it usually goes to other comprehensive income. But in case there was a previous revaluation loss, it has to go where the previous revaluation loss went. So if the previous revaluation loss actually went to statement of profit or loss, revaluation gain will also have to go to statement of profit or loss first. So actually we would not take it to revaluation surplus. It would actually go to retained earnings because retained earnings is actually a realized reserve, or simply speaking, I would just write revaluation gain, but this revaluation gain would have gone to the statement of profit or loss. I hope you get it. The statement of profit or loss by how much? There was a previous loss of 6 million, so I compensate that 6 million first. I write here 6 million, and then I proceed with the rest. I've remained with 4 million, so that 4 million can now go to revaluation surplus. No problem at all. It can now go to revaluation surplus in the statement of financial position, or you could just say revaluation gain, and this would pass to other comprehensive income, just like this. And here we could put 6 million here. I hope, sorry, your remained is 4 million actually. I hope you got it now. PPE, no problem. The asset increased by 10, but here, all of it was taken to revaluation again through other comprehensive income. But right now here, 6 is first reversing the previous loss, that is to profit or loss, and then 4 million remaining goes to actually revaluation gain. So this is what happens. That's why, simply speaking, revaluation loss goes to profit or loss, revaluation gain to other comprehensive income. So if it is reversing something, you have to go where that thing went. So normally, as I said here, revaluation loss goes to statement of profit or loss, but also it depends. That is explained in point number 4. Point number 4 says that revaluation loss is usually taken to the statement of profit or loss. Revaluation loss is usually taken to the statement of profit or loss, but it depends. If it is reversing the previous revaluation gain, you have to go where, because the revaluation gain, we know that revaluation gain goes to other comprehensive income. So it would first have to go to other comprehensive income. Actually, you have to check and you have to be very careful. Let me tell you one thing, for example, here. This was how much? This was a revaluation gain of 10 million. But checking here, since it went to reverse the previous revaluation loss, it went to statement of profit or loss first. So even if maybe it's something occurs, there is a revaluation loss and I need to reverse, you cannot say, oh, there was a previous gain of revaluation of 10 million. So that all was gone to, was taken to actually other comprehensive income. No. Some will be to other comprehensive income, some to profit or loss. So you will have to deal with only this 4 million that has gone to other comprehensive income. So when speaking of revaluation loss, generally it goes to statement of profit or loss. But if it is reversing the previous revaluation gain, revaluation loss goes to profit or loss. If it is reversing previous revaluation gain, you will have to take it to other comprehensive income. Let's presume here. Let's presume, for example, we have an asset at 50 million, reverse now, 50 million to 40 million. The asset has fallen from 50 million to 40 million. So if it has fallen by this one, and you say that, actually, let's just presume there is no previous revaluation gain. What would you have done? The asset has fallen. So I would credit my PPE as an asset from 50 to 40, which is by 10 million. And then I would have to debit the remaining amount. What would I debit now? I would have to debit the revaluation loss. Revaluation loss. Actually, revaluation loss goes to the statement, actually goes to retained earnings. So I would have revaluation loss. Since it goes to retained earnings in the statement of profit or loss, in the income statement, it will go to statement of profit or loss. And then it will go to retained earnings. Anything passing through profit or loss goes to retained earnings. So I would have 10 million here, just like this. And now we presume just like at the beginning, let's say, suppose there was a previous revaluation gain of say 3 million. If there was a previous revaluation gain of 3 million, first of all, I would do as normal that my asset would decrease by 10. So I would credit my PPE by 10 million just as normal here. Here I'll write here 10 million, no problem. Then what would I have to do at the top here? I've credited by 10 million. It's obvious that I have to debit by 10 million. My point here is, where does that 10 million have to go? This is what you have to ascertain now. So generally, the revaluation loss would be taken to the statement of profit or loss after offsetting the previous revaluation gain. So the previous revaluation gain normally goes to other comprehensive income unless stated otherwise. Just like here, there was a revaluation gain of 10, but some of it went to statement of profit or loss to reverse the previous loss. So you just ask yourself here. So I would have to debit what? I know that there is a revaluation loss, no problem about that. I know that there is a revaluation loss. I do not have a doubt about this on this at all. So revaluation loss, and this revaluation loss would be taken where? Where would this revaluation loss be taken? Revaluation loss generally goes to the statement of profit or loss, but since it reverses the previous gain and there was a gain of 3, this 3 can be accommodated by this 10 million, so I would have to take it to other comprehensive income first. Actually, if something goes to other comprehensive income, it has to go to revaluation surplus. If it goes through profit or loss, it has to go to retained earnings. You know, revaluation surplus is in the financial position, while revaluation loss is in the other is in the profit statement, income statement. So how much? I will write here 3 million. And then actually I would have again here revaluation loss, another revaluation loss, and this one would be taken to the statement of profit or loss, which would also go to retained earnings. Earning how much? Earning 7, giving up with 7 million. So this is how we account for revaluation model. I hope all has been fine. All right, so let's proceed here. This has an increase in the value shall be transferred. Actually, I've explained point number 4 to this one. Listen, a decrease in the value on revaluation should be recognized as an expense. This is a revaluation loss, an expense, except where it offsets a previous increase taken as a revaluation surplus in owner's equity. This is what I was just trying to speak of. I think I've described this example, I've illustrated an example too. So here we are told, any decrease greater than the previous upwards increase value must be taken as an expense in the statement of profit or loss. There's nothing new here. I've demonstrated everything. So let's just proceed with point number 5. We're told here that immediately after revaluation, depreciation shall be based on the revalued amount and the estimated remaining useful life at the date of revaluation. Immediately after revaluation, depreciation shall be based on the new amount. It's something very normal. Let me just show you something. It's very normal. Let me remind you one thing. Let's presume we are using the straight line method of depreciation. Presume the straight line method. Straight. Let's presume the straight line method of depreciation. How do we obtain the depreciation? Depreciation is obtained this way. We usually take, then we minus scrap value or residual value, actually, and we divide by how much useful life of the asset. So whenever something among these ones change, you have to revise the depreciation. You know, whenever cost changes, maybe you have revalued the asset, like this amount has changed here. Even if the scrap value changes, even if the useful life changes, you have to recompute depreciation. So this depreciation actually could change. There could be a change in the value of this depreciation. You could write it this way. Instead of cost here, you could say the revalued amount. Valued amount like this, and then you will place scrap value over remaining useful life. So you will have to divide by the remaining useful life. The asset had a useful life of 20 years, 4 years have passed, and you have made a revaluation. You are remaining with 16 years. So use that revalued amount, use that 16 years and go forward. So that's what we do. Actually, I would like to make an illustration here. Let's just presume. Let's say you have an asset, you buy an asset at cost on what? On, let's say, on 1st January 2017, something like this. You buy an asset, let's say you bought an asset on 1st January 2017 at how much? At let's say you bought it at $200 million, something like this. And at that date, I'm repeating again, the asset had a useful life of, let's say, 10 years, and actually, let's say it had a residual value or scrap value of, let's say, of 20 million. That means at the end of 10 years, we could recoup 20 million from actually selling it. So let's say this is the case. And let's say now, 2017 passes, 2018 passes, 2020 passes. How many? Oh, let's compute first depreciation. Depreciation for the year. What would be the depreciation for the year? Depreciation. Yeah, how much would it be? We know that depreciation, we use cost, that is 200 million, minus scrap value, that is 20 million, divided by the useful life of 10 years, ending up with how much? 180 million divided by 10 million, we remain with 18 million. This is what would be the depreciation each year. Let's say we are at the end of which year? This is 2017 has passed, 2018 has passed, and 2020 has passed. So 2017, 2018, 2019, 2020, let's say 4 years have passed. So accumulated depreciation at the end of 2020, 31st December 2020, what would it be? I would take the depreciation per year, that is 18 million, and multiply it by 4, ending up with 72 million. This is what I would have now. So this would be the accumulated depreciation. So let us now compute the carrying amount. What would have been the carrying amount at that date? Carrying amount would have been this way. I would take my cost, that is 200 million, and then I would less the accumulated depreciation, which is 72 million, actually ending up with 128 million. This would be the carrying amount. Now, let's presume that at the end of 2020, I made a revaluation to obtain the revalued amount. That means my asset would have to be revalued. Let's say I had the revalued amount, which is the fair value. I computed the fair value and found out that the fair value was actually let's say it was 160 million. Let's just presume this. I had a fair value of 160. So if I had a fair value of 160, first of all, you would like to compute whether there is a revaluation gain or loss. So the carrying amount is 128 million, but the revalue amount is 160. This implies a revaluation gain. This implies a revaluation gain of how much? It implies a revaluation gain of actually 28 million, 32 million, right? 32 million. How did I get the 32? I took 160 million minus 128 million and obtained 32 million. So this is what would have been the case here, just like this. This is what would have been the case. So after having obtained something like this, suppose now 2020 has passed. I'm speaking of the year 2021. So in the year 2021, how would I compute the depreciation? Because I would open up the year 2021 with a revalued amount of 160, right? So if I opened it, I opened with the revaluation gain of revalued amount of 160. To compute the depreciation now, the new depreciation would be computed as follows. I would take the revalued amount. This is our point now. I will have reached the point. Without the amount that is 160 million, less scrap value. The scrap value, we presume that it hasn't changed. It was 20 million there, or residual value, this one here. And then I would have to divide by the remaining useful life, remaining. Now, the asset had 20 years. Sorry, the asset had 10 years, but actually 4 years have passed. We are the December 2020 from 1st January 2017. 4 years have passed, so we have remained with 16 years. That means 20 minus 4. So if we have something like this, you obtain the new depreciation. 160 million minus 20 million, you get 140 million. 140 million over 16, that would be 140 million over 16. It's like 70 over 8, 35 over 4, which is 8.37 or 8.75. So I would have a depreciation of 8.75 per year. This is what I would have at my disposal. So actually everything will go well. So if this is how we compute the depreciation, that's why you say we base on the revalued amount. I hope everything has just gone well. Now let's proceed with point number 6. Number 6, or sorry. Point number 6, oh, it's just coming back by itself. Let me reduce some items here. I think this is going to go up by itself. Let me do this. So actually, if we go to point number 6, we'll see something. We are told in point number 6, on realizing the revaluation surplus, the entity may choose either, when realizing the revaluation surplus, there are a lot of things that can be done. Revaluation surplus is unrealized reserve. Actually, out of all components of equity, it's only retained earnings that is realized. Everything remaining it does not go to realize the reserve, share premium, share capital, a lot of things. So what we do here, when we're told on realizing revaluation surplus, the entity may choose either. First of all, what do I mean by realizing revaluation surplus? What do I mean by that? In equity, under equity, we have retained earnings, but also we have revaluation surplus. Now, we are told on realizing, let's say you have sold an asset. If you sell an asset, you do not need to remain with the revaluation surplus of that asset. You can just actually realize it, shift it all from revaluation surplus to retained earnings. That means realizing it. So we have a lot of choice. First of all, on realizing it, let's say you have disposed an asset, and that revaluation surplus actually, you cannot do anything about that because the revaluation surplus is only changed for a given asset. That's why you say you cannot offset the revaluation gain in the revaluation loss for different assets, even if they belong to the same class. Never ever can you do that even once. So that's also another point. So here we are told, on realizing revaluation surplus, the entity may choose either to transfer the whole amount to retain the earnings on disposal of the asset. You have disposed the asset, you had a revaluation surplus. Let's say here you had a revaluation surplus of 20 million, you have realized it all. So if you want to realize the revaluation surplus and you want to eliminate it, the revaluation surplus is equity, which has a credit nature. So I will debit that revaluation surplus in full by 20 million here, and then I would have to credit the retained earnings. by 20 million again. That means I move that revaluation surplus from revaluation surplus reserve to retained earnings. That means actually I realize it. So that's what I would have to do. But also we are told you can transfer each period from revaluation surplus to retained earnings the excess depreciation caused by upward revaluation. You know, what means by excess depreciation? If you have an asset, let's say you had an asset at which point there was a certain depreciation, maybe there was a depreciation of 2 million. If you revalue that asset, that means its value will go up. If its value will go up when you depreciate it, you can find out that the depreciation has changed. Maybe it has changed to 3.5 million. This difference at 3.5 and 2 million arises here because of the revaluation. Now look at its impact. Depreciation will increase. An increase in depreciation will increase an expense. An increase in expense will reduce the profit. That profit usually goes to retained earnings. So retained earnings will be reduced. So if you see now is an upward revaluation has an effect of reducing the retained earnings while it has an effect of increasing the revaluation surplus. So to balance matters, the revaluation surplus makes a promise. The revaluation surplus makes a promise to Mr. Retained Earnings. Oh, Mr. Retained Earnings, do not worry. All is well. All is fine. Do not worry about the income statement. The income statement is just a way of obtaining comprehensive income that is taken to revaluation surplus. Let the matters be like that. Let your profit seem to have been reduced, but when you reach to the revaluation surplus, that is our final destination, I will take it back to you. So that this is what happens. So when you reach at the statement of financial position, you remove some amount. Let's say 3.5 minus 2 is how much? Excess. We call it excess depreciation. This is excess. Excess depreciation is actually 3.5 million minus 2 million, ending up with 1.5 million. This is the excess depreciation. So what we do with this excess depreciation is, in the statement of financial position at the end of each period, this is what we do. We eliminate it from the revaluation surplus, let's say 1.5 million, and then we shift it as promised to retained earnings 1.5 million. This is what we do now. It's very, very simple. Or you are told that both of the two, you could use both of the two. By both of the two, what do I mean? You know, the double entries are just like here above, but here we took it all, but here we took it partially each year. Let me tell one thing. You can use both of the two. Why can you use both of the two? Let's say you are shifting the revaluation gain each year. That revaluation gain, that excess depreciation each year. Each year you shift it, but it happened that maybe you have to shift it for 5 years, but after 2 years have elapsed where you are using this excess depreciation transfer, you dispose of the asset. If you dispose it, actually, you do not need to transfer annually again because you have realized it already. So you could just use this point number 1 here for the remaining years and shift it all from revaluation surplus to retained earnings. So that's why we say both of the two. So this is what we do. I hope everything had been very, very much clear. But actually, I need you to gain something very important. You know, this shifting of excess depreciation actually relates solely to revaluation. Let's say you have an asset, its useful life has changed. You know, the asset can be revalued, but also its useful life can change. So that depreciation can have a lot of effects. That depreciation can come from a lot of reasons. Maybe it's because of revaluation, but also it's because of the change of the useful life. So when in need of computing the excess depreciation, you only consider changes in the revaluation gain. You only consider changes in the revalued amount. All other things remaining constant. Depreciation is obtained by revalued amount minus scrap value over useful life. Presume all other things are constant, and then you compute this excess depreciation. So if the remaining life has changed, recompute this original depreciation using that remaining life. Or to make matters simple, to simplify matters, just do this way. Need to know this annual transfer of depreciation, you just do this. Just take the revaluation gain that you obtained and then divide by the remaining useful life. This one is very simple. Divide divide by the remaining useful life and all will be fine. This one is simple. Instead of computing depreciation, just use this. Revaluation gain divided by remaining useful life and all will be fine. So I hope everything is fine here. In case you find any difficulty, you can tell me to make a more detailed description with another example. So this is what I was speaking about. Excess depreciation is the difference between depreciation after and before revaluing, but using the remaining useful life. So if useful life has changed, you also have to compute that remaining, that original depreciation. Or there's another way, just take revaluation gain of the remaining useful life. This one is much simpler. So I think let's just finish up here. This I think I already stated this. You cannot offset the revaluation loss of one item by revaluation gain of another, even if both items belong to the same class. When offsetting, I said, let's just go back here. I think you remember these points, point number 3 and point number 4. I said that if there is a previous revaluation gain, it is usually taken to other comprehensive income. But if it's offsetting the previous loss, you take it first to what? If it prevents the previous loss that went to profit or loss, you also take it to profit or loss. This is usually done only on the same asset. Even if the assets are in the same class, you cannot do that. Never once again can you do that. What do I mean? Let me stress this point here. I'm stressing it, and so you also be careful on this. Let's say you had plant one. Plant one actually had a revaluation gain of 20 million 4 years ago. And now you have plant two now has been found to have a revaluation loss of 30 million now. Revaluation loss is usually taken to profit or loss. You cannot say that you will reverse this revaluation gain. Revaluation gain and losses are offset only when they belong to the same asset. Offsetting, I'm repeating again, offsetting is only allowed on the same asset. This is what we do. Offsetting is only allowed on the same asset, nothing more, nothing less. Actually, there was some examples to go through, but I would like you to go through and share the results actually in the channel, because I think you have explained everything. We'll actually come and proceed with this review of useful life and residual value. But first of all, I would like you to try these examples. Try these examples here. Let me show you. Here. Try this example number 2 here, but also you could try this example number 3. Try them, number 2 and number 3, and then share in the group, and then I could have something to say. And so the next time we'll solve this ACCA question here. Let me check it. There's an ACCA question here, a very fine one, a very fine ACCA question. I think it's here. Yeah, item A and item B. There are matters of depreciation, actually annual transfers, disposals, acquisition. So there is a lot. So we'll just part through this ACCA question, just solving it all the way before proceeding further. So actually, thank you very much. If you haven't subscribed, subscribe to the channel to support the channel, but also you could share the link to your fellows so as to enhance the channel, but also to help them. Anyone studying ACCA, CPA, CAs, we give support in all that. So actually, thank you very much. And until next time, when we come to the review of useful life and residual value. All right, goodbye.